Fixed income securities defining elements. This is the first reading in the fixed income topic, so let's just start out by covering a few basic terms. You will hear the term fixed income securities. Other terms that are used interchangeably are bonds and debt securities. And the idea here is that a company is raising money by issuing securities, and these three terms can be used. So a company is issuing fixed income securities, or we can say that a company is issuing a bond. A bond is a fixed income security, or there are other debt securities, and debt securities and fixed income securities, these terms are also used interchangeably. Raising money through fixed income securities is the most prevalent method of raising capital. So, in simple terms, there are two broad ways in which a company can raise capital. Either a company raises equity capital or a company raises debt capital. So, with debt capital, a company is making a commitment that if it receives money now, it will make a certain set of cash payments in the future. So this debt capital is what we are talking about. And the term used for this debt capital could be fixed income securities, bonds, or debt securities. Another point here is that we talked about bonds when we were covering financial reporting and analysis. But there is a difference in how we are approaching bonds. When we were talking about financial reporting and analysis, we were taking the perspective of a company. So a company issues equity, a company issues bonds, and we were looking at how a company values a bond on its balance sheet. So in FRA, we had a company perspective. Now, in this segment, we are taking an investor perspective. So an investor can buy equities or an investor can buy bonds. And now we are looking at how an investor thinks. And in that context, diversification benefit is important, because if an investor already owns equity, so an investor has shares in different companies, the investor can diversify his or her portfolio by also investing in bonds or fixed income securities. These are the different segments of the reading. First, we will give an introduction of a fixed income security. Then we'll talk about the bond indenture. So this is the legal document associated with a bond, and investors need to understand the legal arrangement that they have with the company that issues the bond or the entity that issues the bond. We'll talk about legal, regulatory, and tax considerations. Then we'll talk about principal repayment structures, so the different ways in which the company can repay the principal amount. For example, the principal amount can all be paid at the end, or there are situations where the principal amount is paid over time. We'll talk about coupon payment structures. Then we'll talk about bonds with embedded options. So here our discussion will focus on callable and puttable bonds. And the last part of this reading is about convertible bonds. There are three important elements an investor needs to know when investing in fixed income securities. The first is a bond's features. The second is the legal, regulatory, and tax considerations associated with the bonds that he is evaluating. And finally, contingency provisions. In section 2, we will focus on the bond's features. These items will be discussed in subsequent sections. So let's look at the basic features of a bond. One of the most important things to consider is the issuer. In other words, what entity is issuing the bond. One way of classifying bonds is by the type of issuer. And here are different kinds of issuers. We might have supranational organizations such as the IMF or the World Bank issuing bonds. We might have sovereign governments such as the government of the United States or the government of Italy issuing sovereign government bonds. We can also have non-sovereign government bonds. These might be state bonds or municipal bonds. And then we can also have companies issuing bonds. When companies issue bonds, these are called corporate bonds. A high-level point here is that bondholders are exposed to credit risk. This is the risk that the issuer will default on coupon payments or principal payments. Generally, the credit risk is low with sovereign bonds or supranational organizations and somewhat higher with corporate bonds. But even within corporate bonds, different issuers will have different credit ratings, and another way of categorizing bonds is based on credit ratings. We will talk more about credit risk later. Each bond will have a maturity date. This is the date by when the outstanding principal payments need to be made. Take a simple example. Say we have a 10-year bond which is issued on 1st January 2010 and the maturity date is 31st December 2019. This means that by 31st December 2019, all the principal payments need to be made. After this date, the bond ceases to exist. You also need to understand this term called the tenor. Tenor refers to the amount of time remaining for the bond. As an example, let's say we are at this point in time, which is 4 years after the bond has been issued. Here, another 6 years remain till maturity date. At this point, we will say that the tenor of the bond is 6 years. Two more terms that you need to be aware of are money market securities and capital market securities. Money market securities are securities which have a maturity of 1 year or less. Capital market securities are securities which have a maturity of greater than 1 year. In some countries, there is also a concept of perpetual bonds which do not have a maturity date. These bonds keep paying a certain coupon rate based on a certain par value and a coupon rate, but these are extremely infrequent. Every bond needs to have a par value. This is the principal amount or the principal value that needs to be paid at maturity. Let's say that the par value of a bond is $1,000. This means that for that particular bond, $1,000 needs to be paid back to the investor at maturity. This par value is extremely important because generally bonds are quoted as a percentage of par value. So if we take this bond and the price is quoted as 95% of par, what that means is that the bond is trading for 950, which is 95% of 1000. Also, the coupon rate is quoted as a percentage of par value. Next, we come to coupon rate and frequency. Let's say that we have a 3-year bond with a par value of 1000. The coupon rate is 10% and this is a semi-annual bond, which means that coupon payments are made every 6 months. We will first consider the simplest kind of bond, which is also perhaps the most common type of bond, and that is called a plain vanilla bond. This is also called a conventional bond. When the coupon rate is 10% and we have a semi-annual bond, this means that every 6 months the coupon payment is 10% over 2. The coupon rate is an annualized number, and since the payments are being made every 6 months, we need to take half of 10%, which is 5%. For a $1,000 par value bond, the payment then will be 1000 into 5%, which is equal to 50. And if we are to draw out the cash flow over here at the end of period 1, which is at the end of 6 months, the payment is 50. The same payment is made at the end of every 6-month period, And at the end of the final 6-month period, we have the coupon payment of 50 plus the principal payment of 1000. This was a simple or a conventional bond. We can also have something called a floating rate bond or a floating rate note, where the coupon payments are based on a floating rate such as LIBOR, which is the London Interbank Offer Rate. The payment at the end of every period for a floating rate bond is based on LIBOR or the floating rate at the start of the period. Some floating rate bonds will specify that the coupon rate is equal to LIBOR plus a certain number of basis points. Let's say that we have a bond where the coupon rate is LIBOR plus 50 basis points. In case you don't already know this, 100 basis points is equal to 1%, and that means that 50 basis points would be 0.5%, 25 basis points would be 0.25%, and so on. Let's say we have a bond where the coupon rate is LIBOR plus 50 basis points. In case you don't know this terminology, 100 basis points is equal to 1%, and therefore 50 basis points is equal to 0.5%. Let's say that LIBOR at the start of this period is equal to 5%. The coupon rate will then be 5% plus 0.5%, which is 5.5%. And then the coupon payment, remember, is semi-annual. So the coupon payment at the end of the period will be half of this number multiplied by the par value, which is 1000. And finally, we come to currency denomination. This is the currency in which a bond is issued. So if we have a dollar bond, this means that the bond is issued in dollars and the coupon payments and the par value will be paid in dollars. We could also have a euro denominated bond which would be issued in euros, and then payments would be made in euros. A dual currency bond is one where the coupon payments are made in one currency, say the dollar, and the principal payment is made in another currency, say the euro. Let us now take a look at example 1 from the curriculum. And what I have done here is just picked the question. I'm not showing the options. We will use the questions to cover the important concepts. An example of a sovereign bond is what? Sovereign bonds, as we have discussed, are bonds issued by sovereign governments. So a bond issued by the US government or a bond issued by the German government would be a sovereign bond. A bond issued by the World Bank or a bond issued by the state of Minnesota would not be classified as a sovereign bond. Next question. The risk of loss resulting from the issuer failing to make full and timely payments of interest is called what? This risk is called credit risk, and the question very nicely defines credit risk. Next, a money market security most likely matures in what period? If you recall, we talked about money market securities as those securities which mature in less than 1 year. And then we had capital market securities which mature in 1 year or later. And we talked about capital market securities which mature after 1 year, or they have a maturity period of greater than 1 year. If a bond's price is higher than par value, then the bond is trading at a premium. This is something we'll cover briefly here and then in a lot more detail later. Let's say that a bond's par value is 1000. If a bond is trading at, let's say, 102% of par, then we say this is a premium bond. If a bond is trading at less than par value, say 99% of par, then we say that this is a discount bond. A bond has a par value of 100 and a coupon rate of 5%. Coupon payments are made semi-annually. What is the periodic interest payment? This is a semi-annual bond, which means that we take the 5% divided by 2 and get 2.5%. 2.5% of 100 is 2.50. So payments every period, which means every 6 months, equal this amount. Question 6. The coupon rate of a floating rate note that makes payments in June and December is expressed as 6-month LIBOR plus 25 basis points. Remember, 25 basis points is 0.25%. Assuming that the 6-month LIBOR is 3% at the end of June and 3.5% at the end of December, the interest rate that applies to the payment due in December is what? Let's just draw this out. Say this is the end of June, this is the end of December. We are told that LIBOR is equal to 3% over here and 3.5% over here. The spread is 0.25%, so the relevant rate at the end of June is 3.25% and end of December is 3.75%. The payment is being made over here, and one thing that you must remember with fixed income securities and with interest payments is that the interest payment for a given period is the rate in effect at the start of the period. That rate at the start of the period is 3.25%. So that is the correct answer. And finally, the type of bond that allows bondholders to choose the currency in which they receive each interest payment and principal payment is a currency option bond. Now just remember this. I did not explicitly say this earlier. I talked earlier about a dual currency bond where the coupon payment is made in one currency and the principal payment is made in another currency. The distinction here is that the bondholder can choose the currency in which he receives interest and principal payments, and that sort of a bond is called a currency option bond. And this should be easy to remember since the holder of the bond has the option. That's why this is called a currency option bond. Section 2.2 deals with yield measures. Here you need to understand the concept of current yield or running yield and the concept of yield to maturity. The current yield is simply the annual coupon divided by the price of the bond. Let's consider a simple example. Say we have a bond which is priced at 95. Another way of saying this is that the bond is issued here for $95. And let's say that this is an annual coupon bond where the coupon payment is $10 or 10% of par. Par value is 100. So the coupon payments are 10, 10 and 10, and then the par value is returned at the end of 3 years. The current yield is simply the annual coupon, which is 10, divided by price, which is 95. And then you can multiply this by 100 to come up with the current yield. Running yield is another term used for current yield, but this term is more commonly used. Yield to maturity is the annual yield that you will get if you hold the bond till maturity. It is also the internal rate of return or the IRR that you get when you invest in this bond. You can calculate the IRR very simply using your calculator. So for cash flow 0, you plug in minus 95, and then cash flow 1 is 10, cash flow 2 is 10, and cash flow 3 is 110, and then you simply compute the IRR. When you compute, what you should get is 12.08%. And notice that this number is higher than the coupon rate. You can tell that we have a discount bond here. A discount bond is one where the price is less than par value, and with a discount bond, the yield to maturity or the IRR is going to be greater than the coupon rate. We'll see this in more detail in later sections. Two other terms which are used interchangeably are yield to redemption or redemption yield, but the term that is used most often is YTM or yield to maturity. Before I go on, I just want to mention this type of bond which is called a zero coupon bond or a pure discount bond. These are bonds which do not make any coupon payments. For example, you might have a 1-year bond where the par value is equal to 100 and the bond is issued at 90 and there is no coupon payment in between. So this is a zero coupon bond. The interest here is effectively 10 because that interest is represented by the fact that the par value or the amount given back at the end is more than 90.